If you ask most Aussie homeowners, they would say the number one mistake is probably taking out a mortgage in the first place. In this video, we're unpacking the 3 biggest mistakes people make when it comes to taking out a mortgage. We're going to kick off with a bit of a crazy one, which is paying down the mortgage. How can you open with that? That doesn't make any sense. Well, it kind of does when we break it down. Paying down the mortgage is actually giving away your liquidity. When you pay down the debt on a mortgage and make those additional repayments, you can't always access that money without redrawing that cash. And what that means is you are losing liquidity in this situation. The reason paying down the debt might be an issue is because you're missing out on investment arbitrage. And what this means is if your debt is around, say, a 4% interest rate, can you use that money instead of paying down the debt and go invest that money elsewhere in the stock market, in other investment properties, in crypto if that's your space, and get a higher return? Do you think you can get more than a 4% return? I think most people out there believe that they're going to be able to earn more than 4% on their money each year, so paying down the mortgage is the loss of this investment arbitrage. This is the cheapest debt you're probably going to obtain in your life. Owner-occupied debt or investment debt is by far and away the cheapest debt most everyday Australians will be able to access. When you compare it to interest rates on payday loans, credit card loans, car loans, those can sit anywhere between 5 to 15%. But most Aussies will be able to get a mortgage or an investment mortgage anywhere between, say, 4 to 6%. What this means is if you're making those additional repayments and not investing this money elsewhere, you could see opportunity cost. Now, if your risk profile doesn't suit investing the funds elsewhere, you need to make sure that you have a 100% offset account rather than paying down the debt. What this means is you retain liquidity at all times and you can act fast when you need that money. You first of all want to have a 6-month cash flow buffer for your living expenses in case emergencies pop up. And then you want to keep that money on hand for a future investment property deposit or for other investment opportunities that might pop up. So the biggest mistake is actually paying down the debt rather than using those funds for investment or keeping those funds in your 100% offset account to retain liquidity and take up opportunities that arise. Mistake number 2 that almost everyone makes is not turning their bad debt into good debt. Now, the definition of bad debt is it's not producing income for you and it's not growing in value over time. Whereas good debt does exactly that. It grows in value over time and it also brings you cash flow. Now, how do you turn your owner-occupied mortgage from bad debt into good debt? The way I've approached this in my investing journey is to actually get a second loan secured against my owner-occupied property. What this means is my original loan is kept separate and I take out a new loan for investment purposes. What this means is you're using your own home as collateral. You still got that bad debt attached to the property, which is your owner-occupied mortgage, but you've now taken out some good debt, which allows you to use that cash for investing. You can take that money and put it as a deposit on another investment property purchase, leverage that cash to go and purchase another $500,000 or $1 million asset. Let's give you some really quick numbers. Say you bought a property for $500,000. And you took out a mortgage of $400,000. You've held that property for 5 years and it's been on a 5-year interest-only term. What this means is the debt's still $400,000, but over the 5 years, the property might have grown in value to, say, $600,000. What this means is you can take out that second loan attached to the same property, attached to the same security, and use this for investment purposes. So the new loan will be for $80,000 and the original loan will stay at $400,000. You'll now have a $400,000 loan attached to your owner-occupied residence and an $80,000 loan attached to your owner-occupied residence. One is non-deductible for owner-occupied purposes and the $80,000 is deductible and it's for investment purposes. That gives you $80,000 cash, which you can go and use as a deposit on another property. That might allow you to buy, say, a $400,000 investment property somewhere around the Southeast Queensland market or in a major regional location. So don't make that mistake. Don't fail to turn your bad debt into good debt over time. The third biggest mistake that everyone makes is not switching banks and paying a loyalty premium. Australia's big 4 banks make most of their money when Aussies get lazy. When you decide to not move your loan to a cheaper bank because of the hassle of doing new loan docs and getting onto their online bank accounts, you hand more money to your current lender. Australia's big 4 banks are notorious for this, where Aussies are paying a 0.5 to 1% premium to keep their mortgage with their current bank, whereas new customers are getting a more competitive variable rate. On $1 million mortgage, 0.5% or 1% could add up to $5,000 or $10,000 each year. This is just lazy money going to waste. In my opinion, you need to assess your property portfolio and your debt once each year and at least every 2 years. If you can't do it once a year, try and stick to every 2 years. Make sure you're reassessing your debt, negotiating with the bank each year, or looking to switch to a new lending provider. The banks aren't going to be loyal to you, so you don't need to be loyal to the bank. The bank's incentivizing new customers by offering these low rates. So either call them up and ask for a lower rate, like they're offering new customers, or tell them you're going to switch to another bank. You need to keep the banks honest. No one's going to look after your property portfolio other than you. So take control of the situation, have a few free consultations with a few mortgage brokers, have a few discussions with banks, and see what you can do in terms of financing your property portfolio. So to recap, don't pay down the debt, keep it in an offset account, or use those funds for other investments. Make sure you're turning your bad debt into good debt, and don't pay higher interest rates for staying loyal to your current bank. If you want to have a chat with myself, head over to purposeproperty.com.au to book in a free strategy session where we can have a chat about your situation, what you're looking to achieve in terms of building your property portfolio and maybe buying your own home. And I'll break down for you how we work and operate as buyer's agents here in the Brisbane market. We buy 30 kilometres north, 30 kilometres south, and on Brisbane's Bayside. And we're really focused in buying in those established, limited land supply pockets with great fundamentals. If you had a bit of fun chatting about mortgages in this video, bunch of weirdos, make sure you drop a like on this video, subscribe to the channel down below, and click this video over here for more things real estate, renovating, and financial freedom. I'll see you in the next one. Peace.